Hey everyone, welcome back to another deep dive. Today we're going to do something a little different. We're going back in time,
Huh.
back to 1987.
1987.
Whoa. Yeah, to a pretty notable year in financial history. A year that saw one of the most dramatic stock market crashes ever. Black Monday?
Oh, yeah, Black Monday. Everyone remembers where they were.
I wasn't even born yet. But we're going to be unpacking Warren Buffett's letter to Berkshire Hathaway shareholders, written right in the eye of that storm.
Right in the thick of it.
So we've got the original letter right here.
Always love going back to the source.
Me too. And it's full of Buffett's thoughts on business and investing philosophy and kind of how to keep a cool head when things are really getting crazy out there.
I think that's what's so fascinating about this letter. It's like a masterclass in staying calm amidst chaos. You know, while many investors were panicking, Buffett was looking for opportunities.
Yeah. And I know a lot of you are probably thinking, okay, 1987 stock market crash, what does this have to do with me?
Yeah, ancient history.
Right. But trust me, the lessons here are timeless.
Oh, absolutely. Buffett's wisdom transcends, specific market events. He's talking about building enduring value, understanding the businesses you own, thinking like an owner, not a trader.
Yeah, exactly.
Yeah.
So let's just dive right in. Okay.
Yeah.
Let's start by looking at Berkshire's performance in 1987. Despite the crash, Berkshire Hathaway actually saw a 19.5% increase in net worth, adding a whopping $464 million.
It's incredible.
How is that even possible in a year when the market's just completely tanking?
It really comes down to Buffett's focus on business value versus book value, right? He's not just looking at the numbers on a balance sheet.
Right. He's not looking at what the spreadsheets are saying. Okay.
Exactly. He's trying to understand the true earning power of a business. One of the best examples he uses is the sale of Belridge Oil to Shell back in 1979.
Yeah, tell me about that.
So Shell paid $3.6 billion for Belridge, even though its book value was only $177 million.
Whoa, what a difference.
Huge difference.
Okay.
And it shows that sometimes the market undervalues companies. Buffett's looking for those hidden gems, businesses with strong fundamentals that the market might be overlooking.
So it's not just about finding a bargain. It's about finding a good business that's worth owning for the long haul.
Exactly, long-term view.
Yeah. And this philosophy clearly paid off for Berkshire in 1987. In fact, 7 of their largest non-financial units achieved a combined return on equity of 57%.
Wow, that's unheard of.
Unheard of, even in a good year.
Especially in a year like 87.
Right. And it's amazing that he credits a lot of this success to his managers.
Yeah, he talks about the virtuoso performances of his managers.
Virtuoso performances. I love that.
People like the Blumpkins at Nebraska Furniture Mart, Chuck Huggins at See's Candies, Stan Lipsey at the Buffalo News.
I mean, he seems to really value these individuals, not just for their business skills, but also for their character.
Absolutely. For Buffett, investing is as much about people as it is about numbers. He understands that great businesses are built by great people. And, this leads us to one of his most famous analogies, Mr. Market.
Okay, so who is this Mr. Market guy?
So imagine this. You have a character who's always offering to buy or sell your shares. But his moods swing wildly from euphoria to despair. He's driven by emotions, not logic.
Sounds a bit like the stock market itself.
Exactly. That's the point. Buffett is saying that you shouldn't let the market's short-term fluctuations dictate your own investment decisions. Instead, you should focus on the underlying value of the businesses you own.
So while everyone else was panicking during the 1987 crash, Buffett saw it as a buying opportunity.
Precisely. He saw Mr. Market offering up great businesses at bargain prices, and that's the essence of his long-term approach. He's not trying to time the market. He's looking for companies he can hold for years, even decades, as long as they continue to perform well.
Right, as long as the fundamentals are still strong.
Exactly.
Okay, so now Buffett doesn't just talk about these abstract investment principles. He brings them to life through stories about the specific businesses that Berkshire owns.
He loves his stories.
Yeah, so for example, there's Nebraska Furniture Mart led by the legendary Rose Blumpkin, or Mrs. B, as she's known.
Mrs. B.
And she was 94 years old at the time, working 7 days a week. And she was saving her customers a collective $30 million that year.
Wow.
Buffett even includes this funny anecdote about a competitor complaining about NFM's low prices. It's a classic example of how Buffett can just blend humor and business insights.
He's got that knack for storytelling.
Yeah, okay. Then there's the Buffalo News. They had the highest news hole percentage, meaning they were packed with local news, and they even redid the obituary page 7 times a day.
7 times a day. Talk about dedication to detail.
That's intense.
But it reflects Buffett's commitment to quality journalism. He He believes in providing value to readers, not just chasing profits.
It's about doing things the right way.
Exactly. And of course, we can't forget See's Candies.
Oh yeah, See's Candies.
Yeah.
Buffett talks about how Chuck Huggins, a master of customer service, turned a product line misstep into a positive experience.
That's a good one.
So he accidentally discontinued some popular candies and faced customer backlash.
Everyone makes mistakes.
Right. But instead of ignoring the complaints, Huggins reintroduced the candies and sent personal letters and gift certificates to everyone who had complained.
That's how you build brand loyalty.
It's incredible.
Going above and beyond.
Yeah, it's all about building strong customer relationships, which is something that Buffett emphasizes throughout the letter. But he also talks about another critical aspect of business capital allocation.
Oh, yeah. That's where things get really interesting.
Yeah. So he compares the skill of capital allocation to a musician suddenly being asked to chair the Federal Reserve.
What an analogy.
Right.
Yeah.
So you might be a virtuoso pianist, but that doesn't mean you know how to manage the U.S. economy.
Completely different skill sets.
Right. So he's saying that many CEOs might be amazing at running their specific business, but they lack the financial skill set to make those big picture investment decisions.
Exactly. And he argues that too many CEOs rely on consultants or investment bankers for guidance, which often makes the problem worse.
Yeah. So what's Buffett's solution?
He prefers a simpler, more disciplined approach, which is reflected in his own investment decisions. He'd rather acquire well-managed businesses than try to fix poorly managed ones.
Right.
And he's incredibly conservative when it comes to debt.
That's where his famous elephant gun analogy comes in, right?
Oh, yeah.
He says, if you want to shoot rare, fast-moving elephants, you should always carry a loaded gun.
Always be prepared.
Yeah, meaning you should always have access to capital so you can take advantage of opportunities when they arise.
Exactly. But he's not advocating for reckless borrowing. He's talking about prudent financial management, ensuring you have the resources to act decisively when the right opportunity presents itself.
It's all about balancing opportunity and risk.
Absolutely. And this brings us to one of Buffett's concerns. In 1987, the U.S. economy, particularly the growing trade deficit and its potential impact on the dollar.
Yeah, he seems pretty worried about that.
He is. He's basically worried that the U.S. is racking up huge debts to foreign countries and relying on the kindness of strangers to keep financing its spending habits.
He even compares the government's approach to finances to Blanche Dubois from A Streetcar Named Desire, relying on the kindness of strangers. It's a colorful analogy.
Very Buffet.
Yeah, which underscores a very serious point.
Definitely. And this leads to his skepticism of long-term bonds. He sees bonds as being only as good as the currency they're denominated in, and he's not optimistic about the long-term prospects for the U.S. dollar.
So he thinks that this reliance on foreign debt could lead to inflation, which would erode the value of the dollar and hurt anyone holding U.S. bonds.
Exactly. It's a pretty stark warning, especially coming from someone who is generally optimistic about the future of American business.
Right. It shows that even amidst the chaos of a market crash, Buffett is always thinking about the bigger picture and the potential risks lurking on the horizon.
Always looking ahead.
Yeah. Okay, so we've talked about Buffett's approach to capital allocation and his concerns about the U.S. economy, but in this letter, he also gives us a fascinating glimpse into his own portfolio, specifically his permanent holdings.
His forever stock.
Yeah. These are stocks that he intends to hold indefinitely, as long as the underlying businesses continue to thrive.
It's a powerful concept, isn't it? To think like an owner, not a trader, constantly focused on the long-term health and growth of the business.
That's a very different mindset
It is.
than a lot of people on Wall Street have.
Short-term thinking.
Yeah. And in this letter, he specifically names 3 companies that fall into this permanent holdings category: Capital Cities, ABC, Geico, and the Washington Post Company. 3
iconic companies.
Yeah. So what's striking to me is that he's not just buying stocks. He's buying into businesses with strong leadership and these enduring competitive advantages.
He loves those moats.
Right. And remember his quote, "Our goal is to find an outstanding business at a sensible price, not a mediocre business at a bargain price."
Words to live by.
I think so too.
Yeah.
So it's not just about finding a cheap stock. It's about identifying companies that are built to last.
Long-term value.
Yeah. And Buffett clearly believes these 3 companies fit the bill.
He does. He speaks about the managers of these companies with such admiration. You know, Tom Murphy and Dan Burke at Cap Cities, Bill Snyder and Lou Simpson at Geico, Kay Graham and Dick Simmons at the Washington Post. These are names that resonate with Buffett. He sees them as partners, not just managers.
Yeah. There's a real sense of trust and respect there.
Oh, absolutely. For Buffett, investing is about relationships. It's about finding people you can rely on, individuals who share his values and long-term vision.
It's that human element of investing that sometimes gets overlooked.
It's so important, though.
Yeah. Okay, so let's talk about Geico for a second.
One of his favorites.
Yeah. Buffett mentions that Berkshire purchased Geico stock at an average price of $6.67 per share back in the 70s.
Wow.
By 1987, their after-tax operating earnings were already over $9 per share.
That's the power of compounding right there. Let your investments grow steadily over time.
Amazing.
It is.
But Buffett also acknowledges that there are times when it makes sense to sell even if a business is performing well.
When would that be?
So he outlines two scenarios. First, if the market significantly overvalues a business.
Okay. Makes sense.
And second, if he needs to free up capital to invest in something even more attractive.
It's all about opportunity cost, isn't it? Making sure your capital is deployed in the most efficient way possible.
Exactly. It's like constantly evaluating and reevaluating your portfolio.
Always looking for the best use of your capital.
Okay. Now, there's an interesting accounting quirk that Buffett points out when he's comparing Berkshire's controlled businesses, the companies they own outright, to their permanent minority holdings like Cap Cities and Geico.
Oh, yeah. The accounting can get a bit tricky.
It can. So with their controlled businesses, Berkshire can report the full earnings of those companies. But the asset values on their balance sheet never change, even if the businesses have increased in value significantly.
Right, because they control them.
Yeah. But with their minority holdings, they can reflect the current market value of those stocks on their balance sheet. But they can only report the dividends they receive, not their share of the underlying earnings.
So the financial picture isn't always as straightforward as it seems.
It's not. It can be very misleading.
It can. And this highlights Buffett's key message. Ignore the accounting noise and focus on the future earning power of the businesses. Look beyond the numbers to understand the true drivers of value.
It's about seeing the forest for the trees.
Exactly. Now, speaking of distractions, Buffett also has some sharp words for professional investors who were causing a lot of volatility in the market at that time.
He wasn't afraid to call people out.
He wasn't. He was particularly critical of those who focused on what other money managers were doing rather than on the fundamentals of the businesses they were investing in. You know, that herd mentality that can lead to irrational decisions.
Oh, yeah. So he specifically calls out the practice of portfolio insurance, which was all the rage in the 80s.
Portfolio insurance, what is that?
So this was basically a computerized system that automatically triggered sell orders when stock prices declined.
Oh, so basically you're programming yourself to sell low and buy high?
Exactly. And it was one of the factors that contributed to the severity of the 1987 crash.
Wow, I didn't know that.
Yeah, Buffett saw it as madness. He uses a brilliant analogy to illustrate the absurdity of this approach. He says, after buying a farm, would a rational owner next order his real estate agent to start selling off pieces of it whenever a neighboring property was sold at a lower price?
That's a great analogy.
It is.
Right?
It highlights the folly of blindly following market trends and ignoring the underlying value of your assets.
So Buffett believes that volatile markets driven by the irrational behavior of others actually create opportunities for patient, disciplined investors.
It's about keeping a cool head when everyone else is losing theirs.
Exactly. The more manic-depressive Mr. Market becomes, the more chances there are to find bargains.
It's like finding diamonds in the rough.
Exactly. Now, in addition to those permanent holdings, Berkshire also has a significant portfolio of other marketable securities.
Right, so he breaks those down into 5 categories. Long-term common stocks, medium-term fixed income securities, long-term fixed income securities, short-term cash equivalents, and short-term arbitrage commitments.
So a diversified portfolio.
Yeah, a pretty diverse portfolio reflecting Buffett's willingness to explore different asset classes while always seeking value and understanding the risks involved.
And he emphasizes that they have no bias towards any particular category. They're simply looking for the highest after-tax returns while sticking to investments they understand.
Makes sense. Stick to your circle of competence.
Exactly. Now, while Buffett's generally known for his stock picks, he also has some intriguing things to say about fixed income securities, particularly his aversion to long-term bonds.
Yeah, that's interesting.
He sees bonds as being only as good as the currency they're denominated in, and he's not very optimistic about the long-term prospects for the U.S. dollar, given the growing trade deficit and reliance on foreign debt.
We talked about that earlier.
We did. He's concerned about the potential for inflation eroding the value of those bonds, and he compares the government's approach to that of Blanche Dubois relying on the kindness of strangers to finance its spending. It's a vivid image that underscores the potential risks of relying too heavily on debt.
Definitely. But while he's generally wary of bonds, he does make an exception for certain types of short-term and medium-term fixed income securities.
Right. He mentions that Berkshire holds a sizable portfolio of tax-exempt bonds, which have provided them with attractive returns.
And he also talks about their arbitrage activities, which involve profiting from price discrepancies between different securities.
That's an area where Buffett has a long track record of success. He estimates that Berkshire has averaged annual pre-tax returns of at least 25% from arbitrage.
That's incredible.
It is. But he cautions that even the best arbitrage operations can experience losses, particularly during times of market turmoil.
So there's always a risk.
Always. Now, one of the most talked about investments Berkshire made in 1987 was a $700 million purchase of Salomon Inc., 9% convertible preferred stock.
So this was a significant bet on the investment banking industry, which was going through a period of rapid change.
High stakes.
Yeah. But, as always, Buffett wasn't just betting on the industry, he was betting on people.
Who is he betting on?
So he specifically mentions his admiration for John Gutfreund, the CEO of Salomon, whom he describes as a man of integrity and talent.
That personal connection, that trust, is so fundamental to Buffett's approach.
Yeah, he's not just analyzing numbers, he's looking for leaders he believes in.
It's about finding the right people.
And while he acknowledges that the investment banking industry is inherently unpredictable, he believes that a high-quality operation like Salomon can generate good returns over the long term.
Makes sense. It's a classic Buffett investment, a blend of value and growth potential anchored by strong leadership.
Okay. Now, before we move on, Buffett makes an important point about transparency. He addresses the speculation in the press about Berkshire's investment activities.
Oh, yeah. He doesn't like rumors.
He doesn't. He says that they simply don't comment on rumors whether they're true or false.
I can understand why. If they started responding to every piece of gossip, they'd be spending all their time on public relations instead of focusing on what matters, making sound investment decisions.
Right. He makes a great analogy saying, it would be like expecting a media company to disclose details about acquisitions they're pursuing, or a journalist to share their sources with competitors.
It's about protecting their competitive edge.
Exactly. And for those who try to piggyback on Berkshire's investments based on rumors, Buffett has a simple message. If you want to participate in what Berkshire is buying, just buy Berkshire stock.
It's a vote of confidence in his own company.
Yeah. And a reminder that long-term ownership, not speculation, is the path to sustainable wealth creation.
Patience is key.
Okay. Now, before we wrap up this part, let's talk about acquisitions, a topic that Buffett addresses towards the end of his letter.
Always looking for new opportunities.
Right. So he lays out a very clear set of criteria for the types of businesses they're looking to acquire, large companies with at least $10 million in after-tax earnings, a proven track record of consistent profitability, good returns on equity, low debt, strong management in place, and simple, easy-to-understand operations.
Sounds pretty straightforward.
Yeah. He even says, if there's lots of technology, we won't understand it.
He sticks to what he knows.
He does. He's not chasing fads or trying to predict the next big technological breakthrough. He's looking for solid, well-managed businesses with durable competitive advantages.
Those boring but profitable businesses.
Exactly. He also makes it clear that Berkshire won't engage in hostile takeovers. They're looking for willing sellers who share their values.
It's about finding partnerships, not forcing mergers.
Yeah, and he emphasizes their speed and confidentiality. They can typically make a decision within 5 minutes of receiving an offer.
5 minutes. Wow, that's incredible.
It's remarkable. It shows how decisive and efficient Buffett is. He doesn't waste time on deals that don't fit their criteria.
So no drawn-out negotiations?
No. And here's another interesting point, in addition to buying entire businesses. Berkshire is also open to acquiring large, non-controlling blocks of stock similar to their holdings in Cap Cities and Salomon.
So they're flexible in their approach.
Yeah. They're particularly interested in convertible preferreds, which offer a combination of fixed income and potential upside from conversion to common stock.
It's a way for them to participate in the growth of great businesses without necessarily having to take control.
It's a win-win.
It is. So as we've seen in this part of our deep dive, Buffett's 1987 letter offers a wealth of insights into his investment philosophy, his approach to capital allocation, and his unwavering focus on finding and partnering with exceptional businesses and leaders.
It's a masterclass in investing.
Okay.
So we've covered a lot of ground in this deep dive into Buffett's 1987 letter, from navigating market crashes to understanding the nuances of Mr. Market. But before we wrap up, I want to share a story from the letter that really struck me. It perfectly illustrates Buffett's commitment to building these long-term relationships, both in business and in life.
Oh, yeah, I know what you're going to say.
The Harry Bottles story.
Harry Bottle, what a legend.
So this story goes all the way back to 1962, when Buffett was running Buffett Partnership Ltd.
Okay.
And he was facing this challenge that he couldn't quite solve. So he turned to his trusted partner, Charlie Munger, for advice.
Always good to have a sounding board.
Right. And Charlie suggested that he reach out to Harry Bottle, who was this guy known for his no-nonsense approach and ability to cut through complexity and just focus on the essentials.
It's just at the heart of the matter.
Yeah, exactly. So Buffett flew out to meet Harry in Los Angeles. And within a week, Harry was in Beatrice, Nebraska, running Dempster, a struggling farm equipment manufacturer that Buffett's partnership controlled.
Wow, from LA to Nebraska, that's a big change.
Right. And it was a remarkable turnaround.
Mhm.
Harry streamlined operations, focused on core competencies, and just turned the business around, earning Buffett's admiration and the title of Man of the Year in that year's letter to partners.
So he was the original Mr. Fix-Again.
He was. Now, fast forward to 24 years to 1986, K&W Products, a small automotive compounds company owned by Berkshire, was hitting a rough patch.
Uh-oh.
Yeah, they'd strayed from their core business and were losing money.
Happens to the best of them.
Right. And Charlie Munger, who was overseeing K&W at the time, knew exactly who to call. He reached out to Harry Bottle, who was 68 years old at this point.
Wow, still going strong.
And without hesitation, Harry stepped in as CEO. He brought that same focus and discipline that had saved Dempster decades earlier. And within a year, K&W was back on track. Profits soared over 300% in 1987.
That's incredible. What a story.
It is, right? It's this incredible story of leadership loyalty and the enduring power of relationships built on trust and mutual respect.
It's about finding people you can rely on.
Yeah, and it also highlights Buffett's belief in finding the right people and empowering them to do what they do best.
It's about giving people the freedom to succeed.
So as we wrap up this deep dive into Buffett's 1987 letter, I want to kind of shift gears a bit and talk about what all of this means for you.
Let's bring it back to the present.
Yeah. How can we apply these timeless principles in today's world?
Exactly.
So here are a few key takeaways that I've gleaned from this deep dive. First, tune out the noise. Don't get caught up in the hype or panic of the market. Focus on the underlying value of the businesses you're interested in. Think long-term, like an owner, not a trader.
It's about ignoring the short-term fluctuations.
Yeah, exactly. Second, seek out great managers.
Yeah.
Look for companies led by individuals with integrity, talent, and a genuine passion for their work. Remember, you're not just buying a stock. You're buying into a business led by people.
People make all the difference.
They do. Third, be patient and disciplined. Don't chase quick profits. Instead, let your investments compound over time. It's about staying the course even when the market gets turbulent.
It's about riding out those storms.
And finally, never stop learning. Keep reading, keep exploring, keep asking questions. The world of business and investing is constantly evolving, and the best investors are those who are always seeking to expand their knowledge and understanding.
It's a lifelong pursuit.
It is. So before we sign off, I want to leave you with a final thought-provoking question. Buffett reputedly emphasizes the importance of finding good businesses at sensible prices. What criteria would you use to identify a good business in today's rapidly changing world?
That's a great question to ponder. Think about the companies you admire, the businesses that seem to be thriving even in the face of disruption. What sets them apart? What are their core strengths?
Yeah, it's a great exercise for any investor to really define what good means to you, what principles guide your investment decisions.
It's about developing your own investment philosophy.
Exactly. All right, folks. Well, thanks for joining us on this journey back to 1987. Remember, the best investment you can make is in yourself. Keep learning, keep exploring, and keep diving deep.